Hi, today is Sunday, August 14th, 2022. I'm Jason Shapiro with CrowdedMarketReport.com. Today I am going to do something that I usually don't like to do, which is talk about a specific market and specifically which way it may or may not go. And there's a number of reasons why I don't like to do this. The first one being it's a complete jinx. I'll get on here and make a bullish argument. It'll be the top tick, and not only will I look like an idiot, but I'll also lose money because I'm long this particular market. But so I'll preempt this whole thing with saying I can be wrong at any time. The data that I'm talking about can be wrong at any time, and markets can do anything at any time for any reason. So let's go back to the most important thing, which is risk management and discipline. Okay. Having said all that, let's talk about the stock market, the U.S. stock market right now, and the reason I get into this is because what we had here was a few months ago, let's call it June, mid-June, where a lot of the sentiment numbers were just off the chart bearish, and which also followed through in the positioning stuff that I like to look at, which was off the chart bearish. So it offered sort of a good risk reward long, and that's fine. It's kind of, what do we do now? And this is really what I'm trying to point out is it's amazing to me somewhat that people are no less bearish than they were back then. All you hear on TV, in the newspaper, whatever you want to read, is how this is a bear market rally. They start every conversation when they talk about the stock market. Well, this bear market rally could do this or that or the other thing. That's pretty bearish undertones. The fundamental people absolutely hate it. And so what has happened into this rally is this, right? Let me just switch this. It gets a little weird, but oops. Sorry, my technical expertise sucks. So this is the positioning right now. Well, this is as of last Tuesday for the equity indices added together, the Dow, the S&P, the Nasdaq, and the Russell. This is the positioning, and what this blue shows is large speculator positioning, and the yellow shows sort of small speculator positioning. And they've gotten nothing but short as the market has gone up. And it's somewhat amazing to me because you have a bunch of, these are futures data. A large part of the futures data traders are CTAs who are systematic for the most part and who are trend follower for the most part. So you would think they would be, at the very least, be getting stopped out of shorts here. And depending on how long their trend following stuff is, short or medium term stuff would actually be getting long here. So how is that speculators are still getting short? All that CTA has to be made up for by other sort of discretionary traders and fundamental traders and whatnot, and they're just getting more and more bearish. And it points to me that the combination of that and the fact of what all these talking heads are saying all the time about how bearish they are, it points to me that the market is going to continue to go up. And again, could be wrong, but even if it's right, doesn't mean it's going up tomorrow, doesn't mean it's going up this week, you know what I mean? Markets fluctuate, but the risk reward trade continues here, in my view, and from what I look at, to be long. And how, this is what I've gone through this week, how are we ever going to get out of this trade? Because how is anybody ever going to get long here? Well, the systematic guys will get out because they are forced to. And I believe a lot of the fundamental guys will get forced to get out. Now, they might not get long because they can't build a fundamental bullish argument. But at some point, risk management is going to come into play, and they're going to get stopped. And what that will show is they will get stopped out. And I think it's an important thing because these fundamental guys, they could be 100% right. In fact, I've made the bearish fundamental argument I started making back in November of last year is horrible. It's horrible what the Fed's done for the last X number of years, and the piper that has to be paid for all that stuff is a horrible situation. And in fairness, when everything blew up in '08, I worked at a hedge fund that had a lot of very smart fundamental people, and they were bearish. Now, having said that, they were bearish in 2006, 2007, and 2008, but were bearish, okay, and had that right. Whether they made money off it or not over that period of time is a whole nother story. But so it's not that they can be wrong about the fundamental, it's that the market can screw them up first. And the reason it screws them up first because everybody gets too short, because everybody sees it, squeezes them out. Once it squeezes them out, then okay, that sort of fundamental thing can work. And I guess as a point to this is the chart of the same data, the COT data. This starts in the beginning of 2007, all right? And you can see that speculators started getting super short, right, in 2007. By the time we got to September, they were mega short, right? And this is the commercials, which is the opposite, right? But look at, and this is what you can't predict, look at this 1 week move in the position, right? The commercials, and this is on September 18th, 2007. And at that point, you'd be saying, oh my God, look how long the commercials are, and therefore look how short the speculators are. You want to be long. In 1 week, commercials went from this massive long position to basically a little bit short, right? Which means that the speculators went from a massive short position to a little bit long, right? And you can see that here, they're massively short, and boom, large speculators are neutral, small speculators are long. And so this happened the week of, and you never could have predicted that a 1 week move in this data. You can see the move, it doesn't usually move that much in 1 week. You never could have predicted that this would have happened in 1 week, but it did. And the week it happened was the week after 9/19. So you're looking at the week of 9/25/2007. So let's go to our chart, right? If I can figure out how to do this. This is an S&P chart for that period of time, all right? And 9/25, September 25th, 2007, the week they made that big move, is here, okay? Right there, all right? Which was basically, call it 2 to 3 weeks before the ultimate high of the stock market, which then went through its 2008, crash, right? So what I'm trying to say is, as much as it looked like this thing was a huge buy, all through here, but all the way up into here, and you would have been like, oh, there's no way they're getting out of this for a long time. Well, in 1 week they did, and they did that right here. All right, so it gave you plenty of time to get out, is my point. And I have this little thing that I think of. If we think about what the market does, right? And this is obviously a very general thing. Here's the wave, right? That's the wave, right? And at the bottom, down here, right, what you have is the fundamentals are horrible, right? That's why the market's been going down. And everybody knows that, and therefore everybody's short. Then you get a bounce, and that's called a retracement, oversold retracement. Then you get a bigger bounce, and that's called a squeeze. Then it continues because now the fundamentals are starting to change, and people are seeing that, so they're starting to get long. And then at the high, the fundamentals have completely changed. It's totally obvious that fundamentals are bullish, therefore everybody is long. First of all, your trend followers are long because the market's going up. Second of all, your fundamental guys are long because the fundamentals have become obviously bullish. And of course, that ends up being your top. The same thing goes the other way. You get a pull back down, that's a pullback. You get the next move, that's a squeeze out. You get the next move, fundamentals are changing. You get the move all the way down to the low, which is the fundamentals have completely changed. It's obvious everybody should. And that's kind of the wave. Now, clearly, it's never that simple, but in general, that's the wave. And if that's the wave, where are we now? Well, I think we're clearly in the short squeeze phase. We had the retracement phase, or the rebound phase. Now you're in the short squeeze phase. You haven't gotten to the phase where fundamentals have changed, because they really haven't. And B, nobody seems to believe that they have anyway, which is more important. Whether the fundamentals actually change isn't really relevant. It's the perception of fundamentals changing. So I feel like we have to get to a point where at least fundamentals people believe that fundamentals are changing. And if that is going to be the case, the market's going to be higher when that happens, because people are still so short. So I guess if you want to, the main thing I'm trying to say here is, getting along here is obviously very difficult, right? The market's overbought. It's probably due for a pullback. I've been saying that for 3 weeks now, and I've been completely wrong about that. But it's probably due for a pullback. Getting along here is a little bit difficult, although the difficult trade is usually over time the right one. The more difficult the trade is, the better it is. But whatever. I'm not saying get long. What I'm saying is, if you want to be short, which a lot of people want to be, at the very least, you don't have to pay attention to commitments of traders if you don't want to. Maybe you don't believe in commitment of traders, whatever. That's fine. Maybe you don't believe in fading, 99% of the people that come on TV that are all saying the same thing. You could sit there and say, oh, well, they're smart and they're right. You're probably saying that because you agree with it, and you want to be smart and right. But regardless of the psychology, let's just say you want to be short. And I don't even argue with you. I do think that's, I think that we are going to go down a lot. I just don't think so now. But let's say you want to be short. At the very least, wait for some form of market confirmation. If you're right about this and the market's going down to new lows, you've got plenty of room here, okay, to make plenty of money, right? At least wait for a market confirmation. Now, there was one, in fairness, I thought, last Thursday. You had a PPI number come out that was supportive of lower inflation, which is supportive of the Fed not raising rates as much as people think, which is supportive of the market, being able to go up. And what you had starting very early in the day, certainly within an hour of the market being open, suddenly the things that should have been leading the market were not. They were lagging the market, which, like the NASDAQ and the higher beta stocks, started lagging the market very early in the day that day. And by the end of the day, the market had come down a lot and closed down. The NASDAQ closed down quite a bit. The S&P closed down. Short that, right? And then, okay, Friday that didn't work, and I will argue it didn't work because people are still too short, but the bottom line is it didn't work. By Friday, we were back to highs. So, okay, stop out. All right, you took your shot on what you want to do. It didn't work. Stop out, take your loss, and wait. At least, if you want to be short, at least wait for confirmation. Don't just short it because you think it's going down and the market's up and everybody's stupid, because you'll get run over. And I'll give you a quick story, and then we'll call it a day here. But I was trading in 90. It was either 96 or 97. I tried to block it out of my mind, but somewhere in there, and the markets were going up. And this was before I even looked at positioning data, right? I was just trying to be Mr. Contrarian. Oh, the market's going up a lot, so I'm going to short it, and the market's going down a lot, so I'm going to buy it. And trust me when I tell you I learned the lesson. That's not necessarily a good thing to do. But so I was shorting it because it was going up a lot, and all these people were telling me it was going up. So I was trying to be a wise guy and short it, but I never was getting any confirmation. I was just shorting it. And one day, Alan Greenspan, who was the Fed chief at the time, came out and made this semi-famous comment now about the markets may be going through some form of irrational exuberance here. So you had the Fed chief come out and say that the markets were irrationally exuberant, and I'm short. I'm like, oh man, I'm a hero. Me and Alan Greenspan, we're right there. We're the only ones who know what's going on. And the S&P gapped down that day. I don't remember what it was, 2-3%. And by the end of the day, it was up on the day. And I at least knew at that point in my career that I was dead when I got out of those shorts. But I had been shorting it for months anyway, so I lost so much money. But this is my point. And the market was irrationally exuberant, and it did top and crash in January of 2000, 3 years later, right? So point being, you want to be short for whatever reason. I'm not here to argue with you. I'm just here to sort of make the plea of at least wait for the market to confirm it before you get short, all right? And this will save you some money, and if you end up being right, you're still going to make your money. The market at some point, will confirm your view. All right, so that's what I have to say today. If there's any questions or comments, please let me know, and we'll talk again next week. Thanks.